So you may not feel it in your pocket just yet, but Stats SA says the prices of goods and services dropped slightly to 6.8% in April. Prices had shocked markets in March, jumping to 7.1%. The main contributors to the 6.8% annual inflation were food and non-alcoholic beverages, housing and transport costs. Despite the current decline, inflation still remains above the Reserve Bank's target range of between 3 and 6%. The central bank has raised interest rates for the past 9 meetings as it tries to slow down rising prices. The hiking cycle has left many South African households under pressure as the cost of living crisis erodes incomes. The SARB is expected to raise interest rates again on Thursday. Now, for more on tomorrow's announcement, I'm joined now by Roux, an economist from Stellenbosch Business School. A very good afternoon to you. Thank you for your time. There's been a word of caution to South Africans to perhaps brace themselves for yet another rate increase tomorrow because the weight of evidence and opinion supports an increase.
Yes, absolutely. I think there can be little doubt that we're going to see an increase. The evidence, as you say, points towards that. Inflation rate has come down, yes, but it still means prices are rising at a fairly high rate. Prices have not dropped, just the speed at which they increase, so slow down slightly. I must just add, I am somewhere in London in a very public place. I have no control over external noises. So yes, inflation is still way above the top end of the range and even further above the mid-range, which is around about 4.5%. Which seems to be the ultimate target that the Reserve Bank governor is looking for. Now, we add to that the fact that we are still looking at a weak currency, obviously, weaker than we ever thought before. We're looking at the fact that a couple of weeks ago, Treasury pointed out that because of civil servant wage increases, they're going to be spending more than they anticipated. We're not going to have, as we thought, a primary budget surplus, but a deficit. That in its own right is inflationary. We also remember a couple of weeks ago the announcement that minimum wages are going to rise by more than the inflation rate. Internationally, the price of oil remains high. Elsewhere in the world, interest rates are still rising. So if we were not to raise interest rates, the rand would come under further pressure. So yes, an increase seems to be clearly on the cards. The question is, by how much? And how many more times?
As you ask that question, the extent of the increase, is it what market commentators are perhaps predicting or expecting? Is there some sort of a barometer to weigh it up against?
Well, I think 2 weeks ago, there would have been a fair degree of consensus that 25 basis points should be sufficient. Since then, of course, we have seen the shenanigans regarding the Russian, I'm going to call it arms deal in inverted commas, which has set the rand tumbling down even further. And some commentators are saying that that really severe weakening of the rand could call for a 50 basis point increase. I would rather like to see that as being an unfortunate and hopefully temporary situation. Add to that the fact that, let's be honest, South Africans are under extreme pressure. If we were to compile a misery index, then that misery index would be skyrocketing. I don't need to explain everything. Rising prices of food, obviously Eskom, load shedding, absolutely extremely high unemployment, inequality, you name it. So to subject South Africans, already beleaguered South Africans, with a 50 basis point increase, I think might be almost counterproductive. I want to add something else here, and that is quite a few of the factors causing inflation are in any case beyond the control of the Reserve Bank. The Reserve Bank, whatever they do to interest rates, that will exert no influence over the international price of oil or over wage increases or over perceptions, etc. So if I were the Reserve Bank, I'd be looking for 25 basis point increases, but we cannot write off the possibility of a 50 basis point increase. The Reserve Bank does tend to err on the side of being conservative.
What we're running on the channel is perhaps some food for thought for the Reserve Bank ahead of tomorrow's rates announcement, is that inflation has ticked down in April to 6.8%, which is an 11-month low. What do you make of that?
Well, you're going to be very careful how we interpret that. Obviously, we're not saying that prices have dropped at all. Prices are still rising. They were rising at 7.1%. They're still rising, but just at a slightly slower speed. It still means that, at an inflation rate of 7%, prices double every 10 years. The value of money halves every 10 years. So 7.1, 6.8, not much of a difference really. Fundamentally, they have to. They are aiming for 6% minimum, or maximum, I suppose. And we must bear in mind the Reserve Bank has a constitutional mandate, which states categorically that their main aim in life is to combat inflation and to keep it within the target rates. They have no choice in the matter, to be perfectly honest.
So what would be the consequences on the rand exchange rates should South Africa fail to follow suit?
You mean by raising or by raising significantly?
By raising.
Well, if we were not to raise while all around us others are, then all things being equal, the rand would weaken further. And that's one of the realities, the frustrating realities of economics. So a solution for one problem creates a different set of problems. So as much as many of us would like to see lower interest rates, if that were to happen, we're actually accepting a weaker currency, or vice versa. If we want a stronger currency, then we should all be hoping that interest rates will go up significantly tomorrow. So it's one of those catch-22 situations. Yeah. Having said that, if rates were to increase, don't expect the rand to suddenly strengthen. At best, an increase in rates would help to curb the weakening of the rand.
So it all sounds like doom and gloom. Is there any light at all at the end of the tunnel? Have we seen the end of the interest rate increases?
Well, I think it's a bit early to call that. If we look at international evidence and statements and read between the lines, it does seem as if the Fed and European Central Bank are approaching, as they say, the end of the interest rate cycle. So that could mean many things, but it could also mean they will no more increases in sight. If that is the case, then that would support the same kind of thinking here, no more further increases. But as we know, South Africa always surprises us, sometimes on the upside, sometimes on the downside. I think the best case scenario would be a 25 basis point increase tomorrow, and that being the last increase for now. But at the same time, don't expect rates to start dropping 2 months later. We could see them at this kind of level for at least to the end of the year, and perhaps even early into next year. Is the light at the end of the tunnel? Very interestingly, slightly technical, we often look at something called the real interest rate. So it's the prime rate minus the inflation rate. Now, at the current levels, it's actually lower than the average for the last 30 years. So relative to the last 30 years, interest rates are still not extraordinarily high. The other encouraging thing is slightly more psychological. Our central bank has stood proud for so many years as an institution of democracy by adhering to the Constitution. It is one of the very few democratic institutions that sticks to its constitutional mandate. And for that, it earns and enjoys a great deal of international admiration. We really do have, I'm not paid to say this, we do have a world-class central bank. Not always popular, but they're doing the right thing, which albeit sometimes a painful thing. And that augurs well for the general financial stability of the country.
Oh, well, you leave me with mixed emotions, but thank you very much,
Yes.
Andre Roux, and